Forex Focus brought to you by IG, and have a really interesting beginner's guide to day trading here today with 5 different ways to look at day trading, not necessarily strategies that, can help you to necessarily, if you do this, you can make money, you can profit from this. No, we're just giving you the tools here for day trading as a beginner, and 5 different routes that you can go down, and then look to put your own flavor on that and consistently deploy the strategy that you think fits you best. But first, let's start by defining what day trading is and take a look at why you might be a day trader, or at least assign part of your portfolio or part of whatever account to day trading, because there's a bunch of pros as well as cons to this relative to position trading or long-term investing. Now, day trading is defined as the opening and closing of a position in the same trading day, often aimed at short-term profits and losses. And here you have just an example of opening short and long positions and closing them throughout the day. Essentially 3 opening and closing positions in the euro versus dollar Forex market. And we'll talk about, different reasons for opening and closing trades, but you get the gist that essentially you go into the day, whether you're trading in Asia or Europe or the US, flat is called, with no positions on. And then you also end the day with no positions on. That's really the goal of day trading. And this is used by so many people, so many active market participants who have time to, either check their platform on their phone or open up a desktop platform throughout the day, because 1, it reduces overnight risk, which can be especially helpful during times of high geopolitical risk. And we've seen a lot of that recently, right? With, war developing in 2 parts of the world. The last thing you want is to be stationed in the US with a war in the Middle East and war in Russia and Ukraine, and have to worry about, while you're sleeping, what's going on. 1, you'll never get sleep because you'll be awake all the time trying to manage that risk. Or 2, you'll wake up every day to large fluctuations in your account. And so, having fewer open positions overnight can mean less risk while you sleep. And also it opens you up to new opportunities. I don't know how many times, I see a movement in the market or a potential opportunity to buy or sell something. And I look at my available funds and I'm like, man, there's not enough there for me to follow up on this opportunity that I'm perceiving. Closing trades daily can mean more available capital for new ideas. Very helpful, especially in times of greater volatility when most asset classes are moving around. And then also, and this is an underrated one that you can't really quantify, but I know everybody has felt, which is the reduction of your trader emotions. I started out at the Chicago Board of Trade, and I was only allowed to day trade. That was, I go into every day flat and I exit every day flat, no positions on. And of course, you have so many emotions, adrenaline, all these different things kicking in when you have positions on, and some of them are losing, some of them are making money. Where do I take these things off? But the nice thing was, of course you have emotions of I had a good day or I had a bad day, but when I left the office, I didn't have to worry about, this is a position that I'm greedy on, and I think it's going to, I'm already up 1 or 2x, and I think it's going to be 5x. And so I've got to wait for that to happen. And there also weren't those positions that I know all of us get stubborn on sometimes, where it's like, I'm down 1 or 2x, but it's going to come back. And I'm just going to wait to see. And then before you know it, it's down 3x, it's down 4x when you should have maybe gotten out for a loss earlier. So there are some, advantages here to day trading. Of course, on the flip side, And this is why most people who day trade don't necessarily exclusively day trade. You have passive investment going on in your 401k, in your IRA, or in just another brokerage account that has longer term positions. Because, yeah, day trading means you can't necessarily take advantage of longer term trends. And of course, you think about the fact that Apple stock price is up, over 2,000% over the course of the last 20 years. Yeah, you can't day trade and get a return like that in one position. And this the same as Forex price extremes. We've seen recently a slew of price extremes. The euro got down below parity versus the dollar. Dollar yen got up above 150 for the first time in 30 years recently. And those are extremes that you can, either trade with or against on the day trade basis, but you can't necessarily take that medium to longer term view. So there are cons, obviously, to day trading, and that's why most people will diversify across different timetables. They'll have their long-term investment, they'll have their swing trading, multi-day, multi-week trades, and then their day trades as well. Now, why is Forex specifically built for day trading? Well, one, when you're Forex trading, especially at IG, you have 80 plus markets at your disposal. You have, all your dollar-based markets, euro versus dollar, pound versus dollar, yen versus dollar, Australian dollar, Canadian dollar, all these things versus USD, all these different flavors of USD positioning. But then you also have euro versus yen, a very robust market. You have pound versus yen, you have euro versus pound, and then you start to get into your Australian dollars versus New Zealand dollars, and all these different markets that represent 5 different continents, represent news cycles that are pretty much nonstop. Obviously, Asia opening up around 6, 7, 8 p.m. Here in the U.S., depending on where you're at, and then Europe opening a few hours later, and then the U.S., obviously being the U.S. So many different news cycles, so many different diversified opportunities from just the U.S. stock market, where, of course, you could trade Apple, you could trade Microsoft, these different things, and they are diversified in a sense. But if the stock market's doing really bad or it's doing really good, they tend to move in the same direction. Some really diversified opportunities there from each other and from the stock market at large. And then also, since Forex is considered a lesser volatile market most of the time compared to stocks. Now, of course, there are some Forex markets that can really move, but you have markets like the euro versus the dollar or the dollar versus yen that have margin requirements currently as low as 2%. And that's from IG. And those can fluctuate. Those margin requirements can fluctuate. But, being 2% margin requirement means putting up $2 for exposure of $100 in these two markets. That can be helpful for day trading when you're looking at taking small profits. If you're trading $100 worth of Apple and you have to put up $100 to trade it, and you're only looking to make 50 cents or $1, a small profit, that can really hurt your returns at the end of the day, as opposed to that same scenario being played out with a market that's margined at 2%. And then finally, overnight funding rates can produce profits or losses. They're based on interest rates. And so if you're day trading a market that has, and you're long a lower interest rate market, you're short a higher interest rate market, and you would potentially, if you carried that market overnight, have a negative overnight funding rate, you would have to pay, a pip or 2 pips, whatever it is. This is just an example. Day trading means you don't have to see that overnight funding rate. And then, of course, admin fees can play into that as well. And as long as you don't carry that position overnight and you're just day trading, you open and close a position intraday, you avoid those overnight funding rates. Now, let's take a look at some of these day trading strategies. And again, these are just examples of what you can carry out in the market. At the end of the day, you find something that works for you and consistently look to take day trading profit and losses and hopefully end the week or month or a year, whatever it is, up money. But that's going to be up to your decision making at the end of the day. Now, the first one I want to talk about here is trend trading. And this is based on daily net change. What you'll see a lot of traders do sometimes is they'll say, okay, well, the average daily move in the euro dollar market is about 50 pips. Or, if you're looking again at Apple stock as an example, maybe the average day is $1. And say that market is up $1 or the euro dollar market is up 50 pips. And I'm a trend trader, then I'll maybe look at buying that market and riding that trend higher. Same with if it's down 50 pips, I'll look at maybe riding that trend lower, going in the direction of what's called an outside day. It's outside the norm, and I think it's going to continue in that direction. Now, on the flip side of that, you could be a contrarian trader and say, okay, when that market gets to be up or down 50 pips around its average day, it gets outside of those boundaries, I think it's going to come back in and it's going to close more close to zero net change or what would be considered more normal when it does break out of that average range. And so again, you can't necessarily be a trend trader and a contrarian. Those are two different strategies that you can find which potentially works for you. Now, outside of that, you can also take a look at fundamental trading, which, of course, in Forex is very relevant. Economic data releases throughout the trading day and night. And a lot of traders will go into, say, an FOMC rate announcement where the previous rate that the FOMC announced was 5.38%. And they'll have the information going into the event, and then at 2 o'clock Eastern time, if the rate announcement comes out higher than expected, well, then U.S. markets are likely to move in a certain direction. If it comes out lower than expected, then markets are likely to do what they've done historically when something like that happens, and traders might trade with or against that. Just as an example, the U.S. dollar market is very closely tied to what the Fed does with interest rates. And historically speaking, the dollar has witnessed strength when the Fed has hiked interest rates and weakness when the Fed has cut interest rates. So if they were to have a surprise interest rate hike or a surprise interest rate cut, you might expect, respectively, for the dollar to appreciate or depreciate. Now, of course, every day is different. These trends can change, but you catch my drift here that you've got, non-farm payrolls. You've got all these different events that have been around for so long and occur usually on about a monthly basis and tend to affect markets in a certain way. And so you can trade fundamentals that way. Economic data releases, the same as, earnings and stocks. And then there's also technical analysis. And here you can take a look at all the different trading indicators that are based on price action in the market and see which one you think works best, or test out, take a look at, the last several days or weeks or months and test out something like the relative strength indicator that we have here, and see what might work for you if you want to be a technical analysis day trader. And just as the example here, you can see those boundaries in the RSI being around 30 and 70. And when that RSI is over 70, for example, might signal that market is overbought. It's too expensive, maybe worth selling. On the flip side, if it's below that 30, vice versa, it's oversold, maybe worth buying. Again, no guarantee of what the future is going to be, but people will take a look at moving averages and all different kinds of indicators to be technical analysis day traders. And now lastly speaking, and this is maybe one of the most popular variations of this, given that you're day trading, and you have the flexibility of having, like, oh, okay, I've got this capital. It's a new day. I've got this available capital to trade. However I see fit, I'm going to trade based on what news is coming out. And especially if you've traded before, there are times where the news cycle is very relevant and there's a lot of news coming out, and everything that comes out is moving all these different markets, all these different parts of the economy, up, down, and sideways. And there are times where news is less relevant. There's less news coming out in general, and there's maybe less opportunity to trade the news. And so you have to it ebbs and flows like that. But yeah, plenty of people will, for example, take the war in the Middle East currently and look at all the relevant markets, whether it's, the euro versus the dollar or the Israeli shekel, obviously, and trade based on the different developments that are coming out in the news cycle, and have that news right next to your platform, however you get your news. And so there you have it, 5 different ways to day trade, especially relevant in today's market.